Okay, dear students, first of all, welcome to everyone in a very first class of AFM live revision, and this is for session September 2026. Okay, AFM session is September 2026. This is our first live revision class, and we are starting from cost of capital. Okay, now student, before I properly start the class, kindly listen the entire mechanism of live revision classes. Number one, in today's class, we will be revising cost of capital and we'll be revising through questions, okay? Through questions, you will see the revision of cost of capital. Number one. Number two, I would say immediately after this class, I'm going to give around 2 lectures to admin to upload on the portal, and within the portal there's going to be a one folder now from today onwards, and caption of that folder is going to be live revision classes for September 2026. Okay, first of all, obviously those students, they're not here, they can get the recording will be available. Number one. Number two, immediately after this class I will be uploading 2 classes on the live revision folder, and those 2 classes will be on the entire basics of cost of capital. If any one of us needs a very good and quick revision of the entire basic, which I believe after today's class, you will see that almost 80-90% is covered, but still someone needs a, a more detailed revision of basics of cost of capital. So those lectures will also be uploaded. Number one. Number two, students, from here onwards till your exam, kindly do not ignore even a single message which ASA admin is going to share with you, because in each message there is something for you for your attempt. Okay, so you will see that I'm going to give you a proper plan, but for following that proper plan, kindly do not skip even a single message which is coming from my admin, because I'm going to give instruction to my admin. According to that, they will be sharing messages in your relevant WhatsApp groups. So it's my, I would say, humble request that do not ignore even a single message which ASA admin is going to share in your relevant WhatsApp groups. Number one. Number two, after each topic, student, there is a test. For example, if any one of you who has already covered the entire topic of cost of capital, okay, now that student thinks that that student is ready for the cost of capital test, all you need is just message admin that I want to give test of cost of capital. Admin is going to share the question with you separately, of course. You are going to attempt the test. On that test, you will be getting my proper video lecture. Okay. After attempting the test, you have to watch the video lecture, and while watching the video lecture, you have to check your test, whatever you have done. Third, let's say you have attempted the test, you have check your test while watching the video debrief on that question. If you still have any confusion, so you are more than welcome to ask questions directly from me. Okay. Similarly, after cost of capital, let's say you have completed investment appraisal. Okay. Now you want a test on investment appraisal. All you need is just ask admin, share test of investment appraisal with you. They are going to share the test with you. You will attempt the test. After attempting the test, you have to watch the proper my video lecture on that test. While watching the video lecture, you have to check your test by yourself. If you still have any confusion, you are more than welcome to ask questions directly from me. So on each topic, after the completion of each topic, tests are there. Approximately, I would say, or let's say to be exact, there are 10 tests. So I would appreciate try to give all the 10 tests. So because on each topic there's one test, but there is one or two topics on which you will be getting more than one test. So again, please do not ignore even a single message which admin is going to share from here onwards till exam. Okay, I hope everything is now clear to everyone. Now let's just start from cost of capital. Number one, when we say cost of capital, students, simply the cost of capital means cost of financing. Okay. Another question. This is, if someone asks you what is cost of capital, then obviously you will say that cost of capital means cost of financing. Then there's one more question. Another question is, what is the objective of cost of capital? Why do we need cost of capital? The answer is investment appraisal. Actually, for investment appraisal, I need cost of capital. Without cost of capital, let's say I cannot calculate NPV. Without cost of capital, even I calculate IRR, I will not be able to make the decision. I need a cost of capital so that I can compare my IRR against that cost of capital. If IRR is more than cost of capital, then I'm going to make investment. Otherwise, I will not make investment. So I need cost of capital. Without the cost of capital, I cannot go for investment appraisal. So what is the meaning of cost of capital? Simply cost of capital means cost of financing. Second, what is the objective of cost of capital? The objective is very straightforward. The objective is investment appraisal. Okay, fine. Now, let's talk about a company, assuming, and it's a very first live revision class, but student, as I mentioned earlier also, please from here onwards, do not ignore even a single message of the admin. Plus, on the portal, today they are going to create one folder will be created on your portal with the caption of live revision classes September 26th. So do not leave even a single video which we are going to upload on that portal. Second, just after one more class, in each class, we will be discussing the recent past papers. Obviously, relating to the topics which you people have covered. But before attempting a recent past paper question, at least 3 or maximum 4 days before the class, we are going to share that question with you so that you can have 3 to 4 days to attempt that question. Then you will see after just one more class that in each class, we are going to properly solve and discuss a past paper question from the recent attempts, okay? Assuming ABC company is I'm assuming, is a diversified company. Now, what do you mean by diversified company? Assuming they are dealing in two different industries. They have got business one. They also have business two. Let's say your examiner says ABC company is a diversified company. They are not diversifying. ABC company is already a diversified company. They've got two different businesses, let's say business one and business two. An examiner is asking you to calculate WACC, weighted average cost of capital, of a diversified business. A business which does not operate in one industry, a business which actually operates in more than one industries. So the question is how to calculate cost of capital of a company which is a diversified company, which actually operates in more than one industry. Now try to understand the entire, I would say, sequence of calculating a WACC of a company which is already diversified. Step one, you have to find beta asset of each industry. We actually need beta asset of each industry. Now there's a question. How to calculate beta asset of each industry? How to find beta asset of each industry? There is one possibility. If examiner is, I would say, very nice towards you, then examiner might give you beta asset of each industry directly. But if you ask me, sir, what are the chances of this happening? that examiner gives us the beta asset of each industry directly, to me, I would say the chances are next to zero. So it means this will not happen. It means that each time we have to find out the beta asset of each industry. So how to find out the beta asset of each industry? Definitely your examiner will give you the proxy company. Proxy company or any other information. Proxy company means a company which is your competitor in each industry. Okay, examiner will give you the proxy company information. A proxy company means simply examiner is going to give you the information of a competitor, let's say in each industry. So what are we going to do that? From the information of proxy company, from the information of competitor. Now listen, let's say your examiner has given you in industry one, or let's say where you are operating business one, examiner has given you the proxy company. I'm assuming proxy company is XYZ company is a proxy company in industry one where we have got business one. Okay, fine. What you are going to do, you have to take the equity beta of proxy company. You have to take the financial gearing of proxy company and actually convert that beta equity into beta asset. So the question is how to convert equity beta of proxy company to beta asset. Okay. Now let me help you. Actually, when we will be converting equity beta to beta asset, the term which we use is de-gearing. By de-gearing, another word which you can use is ungearing. It's the same thing. De-gearing or ungearing is the same thing. By de-gearing equity beta, we actually calculate beta asset. One more thing, when we say equity beta, logically equity beta is a geared beta. Now the question is, what do you mean by geared beta? Students, try to understand. Equity beta is a two risk beta. Two risk beta means it has the risk of it is having financial risk as well as business risk. Equity beta is a two risk beta. It has the impact of financial risk as well as business risk. Financial risk actually depends on gearing. Financial risk actually depends on gearing. The more business is having loan, debt in the business, it means there is more financial risk. There's a higher financial risk. Logically, the entire financial risk depends on the gearing of the business. The proportion of the loan as compared to equity, that is gearing. The higher the gearing means higher companies facing financial risk. But when it comes to business risk, so whenever you are operating a business, you will have to face a business risk. A very simple interpretation of business risk is fluctuation in operating profit. So it means I have to face the business risk, but when it comes to financial risk, that depends on the loan debt. The more the debt is, the more financial risk business is facing. But when it comes to beta asset, student, beta asset is a measure of risk, but beta asset only measures the business risk. That is why another name for the beta asset is ungeared beta, the beta which does not have the gearing impact. So beta asset only is a measure of business risk. Now try to understand. Beta equity is a two risk beta. Beta asset is a one risk beta. Repeat. Beta equity is a two risk beta. Beta asset is a one risk beta. So logically, beta equity will always be higher than beta asset. Why? Because it has got two risks and it is having one risk. And let me tell you one thing. Towards the end of the syllabus, you are going to find a lecture also. I think it's a 15 or maybe 20 minutes lecture where I have identified there are some mistakes which you are not supposed to make in AFM. because each mistake is going to be very costly. And one of those mistakes is, always remember one point, equity beta is going to be always higher than beta asset. What is the logic behind that? What is the rationale behind that? Because equity beta is a 2 risk beta and beta asset is a 1 risk beta. Now, some of the students, they think, why not? If someone says that what if beta equity is equal to beta asset? This is not possible. It is possible, but try to understand. Logically, if you come across a question, okay, where let's say question categorically clearly says equity beta of the company is equal to the beta asset. If this is the case, then logically, your equity beta is itself a beta asset. Because when we are saying beta equity is equal to beta asset, then logically your ABC company or whatever company it is, then it is 100% equity finance company. Because when you are 100% equity finance company, you do not have a debt, you do not have a gearing. Now try to understand, students, when we do not have a gearing, it means we are not facing any financial risk. As I mentioned earlier as well, that financial risk actually depends on loan. If you take the loan, you will have to face the financial risk. A very simple interpretation of financial risk is payment of interest, payment of, I would say, finance cost, payment of interest. When do we need to pay interest? When obviously we have taken loan. Otherwise, we are not going to pay any interest. So basically, if someone asks you what if beta equity is equal to beta asset, it is possible, then you can say that it is possible, but logically, the business is going to be 100% equity finance. And beta equity itself will be a beta asset here. Okay. Now there is another question. How to convert beta equity into beta asset, or sometime if I need to convert beta asset into beta equity, so which relationship we need to use? Number one. Number two, it is not a student that you need to use, you should know how to use the relationship, plus you should know how to use that particular formula on the spreadsheet as well. Because even at AFM level, okay, you can use that formula, but you can just use that formula in your calculator or maybe just in your register, and you are unable to utilize that, use that formula in the spreadsheet, then there's no benefit at all. So you should know how to utilize that particular formula in the spreadsheet. Now let me tell you, if we are de-gearing beta equity and converting this into beta asset, so look at this. Beta asset is equal to beta equity. Okay. Market value of equity plus market value of debt 1 minus tax rate. This is the formula which we'll be using it. And logically, don't forget one thing, beta equity will be higher and beta asset will be lower. How much lower is not the concept. The concept is equity beta will be higher than the beta asset. Here, we are converting equity beta to beta asset. Whatever the answer comes, logically, that in that answer, your beta asset should be lower than beta equity. Okay, let's say we have found, assuming, to find beta asset of each industry. Now, I'm assuming that by using proxy company information in industry 1 as well as in industry 2, we have found beta asset for business 1, let's say. We have also found, let's say, beta asset for business 2. Now what to do? Basically, we are learning, or in fact, we are revising how to calculate WACC of a company which is already diversified. Step 1, calculate beta asset of each industry. Let's say somehow we have calculated beta asset of each industry. Now, what is going to be the next step? Now, next step is going to be very interesting, students. Logically, we'll be calculating now weighted average beta acid. How to calculate weighted average beta acid? We'll take beta acid of, let's say, business 1 into percentage means weight plus beta acid business 2 again into percentage means weights. And now listen to me carefully, students. Very important concept I'm giving you right now. According to AFM examination team, you should know that there's no one, only a single examiner does not prepare your paper. It is always the examination team for each paper. In AFM examination team, they have categorically clearly mentioned one thing, and that one thing is that hint for the weights will be given to you in exam. So whenever you are facing a question of a diversified company WACC, so what are the going to be the weights? Examiner will give you the hint for the weights. Hint. So as far as weights are concerned, percentages are concerned, hint will be given to you in exam. Now, where I can help my student, I can help my student one way just by giving you few examples. For example, let's say your examiner might give you the weight of revenue. For example, if your examiner says 40% revenue is coming from business 1, it means 60% revenue comes from business 2. I'll be using 40/64 as weights. Another possibility, if your examiner says 30% of equity we have invested in business 1, it means 70% of equity we have invested in business 2. There's another possibility that examiner might give you directly the percentage of investment. Let's say we have invested 35% in business 1, it means 65% we have invested in business 2. So the main concept is hint for the weights will be given to you, but obviously you have to be alert to identify where the hint is, and then you will be using that hint to calculate weighted average beta acid. Now I'm assuming that somehow you have calculated that this weighted average beta acid, I'm assuming, okay, it is 1.4. Just an assumption, please. Step 1 to find beta acid of each industry you have found. After that, to calculate weighted average beta acid, let's say we have calculated weighted average beta acid, which is 1.4. Now, what to do in the next step? Now, this is important, so listen. Now, we'll take this beta acid. Now, we will gear it up. We'll gear up this with own financial gearing. That means we'll be using the financial gearing of ABC company to calculate equity beta. And don't forget one thing, beta acid is going to be lower than beta equity. Now we'll be converting beta acid, weighted average beta acid, by using the financial gearing of own company to equity beta. Now which formula we'll be using? Because right now we need to convert beta acid into beta equity. So logically beta equity is going to be subject. If I use a little bit mathematical term, beta equity is going to be subject. Beta equity is equal to beta acid into market value of equity plus market value of debt 1 minus tax rate divided by market value of equity. So student, you should be very good. Look at this. When we are converting beta acid into beta equity, this is the formula. And this formula we can very easily use in the spreadsheet. In fact, I'll be first explaining the entire question on the spreadsheet on the OneNote. After that, we'll be properly solving that. We are going to solve the entire question on the spreadsheet Excel, so that you should know the presentation as well. Look at this formula. When we'll be converting beta acid into beta equity, and look, come here, look at this formula. Here we are converting equity beta into beta acid. Okay. Now let's say we have calculated equity beta. Now after the calculation of equity beta, we'll take this equity beta and use in CAPM. Then you will get K. So let me repeat all the steps for you. Step 1, to find beta acid of each industry. Step 2, calculate weighted average beta acid. Again, the hint for the weights will be given to you in exam. Step 3, weighted average beta acid. After finding the weighted average beta acid, you have to gear up that weighted average beta acid with your own financial gearing to calculate equity beta. Once you have calculated equity beta, then use that equity beta into CAPM to calculate KE. Okay, now let's come here. Just read the requirement. Calculate cost of equity of Moorland company using CAPM model. They just need what? They are asking us to calculate KE only, okay? By using CAPM. Okay, fine. Now come here. The directors of Moorland company, a company which has 75% of its operations in retail sector and 25% manufacturing. Student, my question is this a diversified company or it is not a diversified company? Kindly reply in the chat box. Is this a diversified company? Yes or no? A very simple reply. Kindly reply in the chat box because I need an interactive class. Thank you. It is a great. It is a diversified company. And it is not only a diversified company. Student, if you read the question nicely, examiner has also given us the weights. Okay. Then let's say in one business, we have got 75% investment. In another business, we have got 25% investment. Are trying to drive the firm's cost of equity. However, since the company is not listed, it has been difficult to determine an appropriate beta factor. Okay, fine. Instead, the following information has been researched. Retail industry. Retail industry. In retail industry, we have got 75% investment. Manufacturing, we have got 25% investment. The retail industry quoted retailers have an average equity beta 1.20. An average gearing ratio is, look at this, 20 is to 80. 20 is the debt, 80 is the equity. Student, examiner has given us the enough information regarding the retail sector, and by using that information of the retail sector, we can very easily calculate equity beta of the retail sector. Then let's see the manufacturing industry. Quoted manufacturers have an average equity beta 1.45, average gearing. The debt is 45 and the equity is 55. Risk-free rate is 3. Again, student, by using this information, we can very easily calculate beta acid of manufacturing industry. Here we can very easily calculate beta acid of retail industry. Risk-free rate is 3%, which is RF. And the equity risk premium. Equity risk premium. Student, I have got 2 questions here. Kindly reply. My first question is, what is the alternative name for the equity risk premium? Repeat. My first question is, what is the alternative name for equity risk premium? And my second question is, equity risk premium, it is equal to what? Alternative, excellent. Alternative name for the equity risk premium is market risk premium. And another answer is also given. Thank you very much. Equity risk premium is actually equal to RM minus RF. Thank you. It is already RM minus RF. So examiner has given us the equity risk premium. Another name for the equity risk premium is market risk premium. Tax on the corporate profit is 30%. Moorland company has gearing. 50% is debt, 50% is equity by market values. Assuming risk on corporate debt is negligible. So this means there's no beta debt. Okay. Now, student, Step one, we have to find beta acid. You are required to find beta acid of each industry. After calculating the beta acid of each industry, in next step, we have to calculate weighted average beta acid. I think once you have calculated weighted average beta acid, then we have to convert that weighted average beta acid into equity beta. Once after calculating equity beta by using CAPM, we can easily calculate K. So let me share the spreadsheet with you. And let me pause the video also so that video should not become unnecessarily very long. Okay, students. We are doing question 1. Simply to find beta acid of each industry. Let's deal with the retail industry. Students, in retail industry, examiner has given us equity beta. Equity beta examiner has given us 1.2. Debt is 20. Equity examiner has given us 80. Tax rate tax rate in percentage, it is 30%. Okay. Now we have to convert that equity beta into beta asset. Simply to de-gear equity beta 1.2. There's no need to write a formula because the formula which I'll be using right now, it will be given to you in exam. So all those formulae which are given to you in exam, if you are writing that formula, any one of them, which is given to you in exam, you are not going to get any additional marks, number one. And second, you will be losing your time, wasting your time. Wasting time means you are losing actually marks. So to de-gear equity beta, so we need to find asset beta. Okay. Student, if now you recall the formula, asset beta is equal to equity beta, which is 1.2 multiply by multiply and then bracket equity beta. Now into market value equity. Market value equity, they have given us 80. I'm using that 80 divided by market value equity plus market value of debt into, now listen student, 1 minus tax rate. 1 minus tax rate. Tax rate is 30%. So 1 minus 30% means I'll multiply this with 0.7. Okay, bracket close. Just a minute. Let me put one bracket here also. So acid beta of, kindly check this, how I've calculated. Acid beta of retail industry is 1.02128. And let me tell you one more thing, students. If you are solving the same question on the spreadsheet and the same question you are solving by using calculator, you will see the difference in the answer, because when I'm using a calculator, then I have the discretion to round off and do everything. Now you might be thinking, sir, we can round off even on the spreadsheet. Yes, we can. But whenever we are calculating any value, spreadsheet takes impact of all the digits. So a slight difference will appear. You will, I would say, face the slight difference when you are solving the same question by using calculator. So that slight difference should be slight, number one, and second, you should not be worried about that difference. Now let's calculate another industry is manufacturing industry. Okay, manufacturing industry. Okay, equity beta. Manufacturing industry, they have given us equity beta 1.45, if I'm not wrong. Then, okay, debt. Actually, the debt is 45 in ratio. Equity, they have given us. Equity, they have given us 55. Tax rate, we know that it is 30%. So simply to de equity beta 1.45. So asset beta, will be using the same formula, is equal to. Now you can use you can create the link if you want to. Like I'm taking equity beta from here, multiply by this. Then I need market value equity, which is this, divided by then bracket, again the market value equity, plus market value of debt into 1 minus t, bracket close. I need one more bracket. So students, I am getting asset beta. Now look at this. Both the presentations are acceptable. Here, when my examiner is going to check, so obviously he will get to know automatically that how did I get this final answer. Here, what I did everything same, but this time I have used the link. So both are acceptable, no issue at all. Now, student, we have found beta asset of each industry. Now, what is the next step, students? What are we going to do? What are we going to do with these two betas? Students, kindly reply. What are we going to do with these two betas? We have got beta asset of retail industry. We have got beta asset of manufacturing industry as well. Can I say now? Okay, someone has replied. Excellent. We need to calculate now weighted average beta asset. Thank you. We simply need weighted average beta asset. Okay, fine. Students, beta asset of retail industry. In retail industry, we have got investment 0.75. Manufacturing industry, we have got investment 0.25. So here comes the weighted average beta asset, which is approximately 1. Now, what are we going to do with this weighted average beta asset? Okay, let's see what is the answer. No. What are we going to do with this weighted average beta asset? We cannot calculate directly KE. Before KE, convert. Yes. No, this is the right answer. Now we have to gear up this. Gear up beta asset 0.99645 with financial gearing of, what is the name of the company? Moorland Co. Again, no need to write a formula. Directly you will have the answer. Equity beta. This time, student, this time we are converting asset beta into equity beta. My question is, right now we are having asset beta almost 1, I'm saying or let's say otherwise 0.99645. My question is, before even getting the answer, just reply one thing. Whatever the answer comes, will it be lower than 0.99645 or it will be higher than 0.99645? This is my question. Logically, whatever the answer comes, will it be okay, higher? Excellent. And the logic behind that is we are actually converting a single risk beta to two risk beta. When we are converting a single risk beta to two risk beta, so obviously two risk beta is going to be higher than a single risk beta. That is a very logical answer, that whatever the final answer numerically comes, but logically, technically, it has to be higher than 0.99645. How much higher is not the main concept. The main concept is it has to be higher than this. And what is the logic behind that? I've explained. The logic is very simple. We are converting a single risk beta into two risk beta. So equity beta is equal to, if I take this weighted average beta asset, something is wrong. I don't know what is that. Okay. Student, Moorland financial gearing, if you see, it is 50% debt, 50% equity. I'm directly using that 50% it is debt, 50% it is equity. So simply market value of equity plus market value of debt. Student, tax rate is 30%. I will show you the formula also on the OneNote, which I'm using right now here. 1 minus T, bracket close, and divided by market value equity, which is 50. I'm getting 1.69396. So logically, we are correct. Why logically we are correct? Because we have converted a single risk beta to two risk beta. So logically, two risk beta must be higher than one risk beta. Mathematically, you should recheck, but otherwise we are correct. So this is what we could have maximum done. Yes. Now very easily we can calculate what? K by using CAPM. So here comes this. Students, risk-free rate is 0.03. It is 3%, am I right? So it is going to be 0.03. Equity risk premium is the difference of RM minus RF. So 0.06 multiplied by equity beta. Whatever comes, let's convert that into a percentage. So students, KE, I'm getting it is 13.2%. Now let me share, let me just show you the formula which I've used when we converted asset beta to equity beta. I have written here. Okay, let me show you where it is. This is the formula, student, when we convert beta equity into beta asset. And the second one is, look at this. I've used this formula. The second formula, when we are converting equity beta, when we are converting beta asset to beta equity, then look at this, what we have in the numerator, market value equity plus market value debt, 1 minus T divided by market value equity. Market value equity is 50 in the question. Market value debt is 50 also. 1 minus tax rate and market value equity is 50. This is the formula which I have used when we were converting this 0.99645 beta asset to beta equity. So I strongly believe the each and every step is crystal clear to everyone. Then how did we calculate this 13.2%? Kindly reply, students. If there is any confusion, you can ask right now. Otherwise, it should be crystal clear to everyone. Okay, Alhamdulillah, it is clear. Thank you. Thank you. Okay. Now let me just show you one thing. Just a minute. Student, look at this. This is a question number 2. Okay. Since it is our first class, so I'm not discussing this deliberately, but take this question as homework. I'm going to share in your relevant WhatsApp groups as well, this question number 2. But I really want every one of you to attempt this question number. But otherwise, definitely in the coming class, we'll be discussing this question and much more. But again, I'm repeating the same thing, student. From here onwards, kindly do not ignore any message which will be coming from admin in your relevant WhatsApp groups. Now, I have to address one query of a student, which I think we did discuss yesterday as well, but I wanted to discuss with everyone. So I hope that student Ruth is here, if I'm not wrong. But before that, let me share this, let me save this PDF and Excel sheet. Let me just whoever is watching recording, let me just tell you, I'm just solving one query. Okay, it is estimated in the first year. Let me repeat for you. First year price means inflation will be incorporated from the second year. The selling price would be 1,000 per component. Variable cost is going to be 400 per component, and total direct fixed cost is a relevant cost 1,500. I'm ignoring 3 zeros. Thereafter, while the selling price is expected to increase by 8% per year. Now stop. Just I want to show you one thing working. Let's say we are calculating sales. Life, they have given us 5 years. T1, T2, T3, T4 and D5. Units are 7,500. I'm ignoring 30. So I'm taking unit 7.5. I hope everyone is okay with this. Then I'm taking 20. Then I'm taking 50, 60 and 95. Student, let me repeat again for you. First year price means logically inflation of the first year is included into that. Okay. So you have to incorporate the inflation from the second year. Selling price is 1,000. Now let me show you something. Selling price is 1,000. But from the second year, selling price is expected to increase by 8%. Now listen to me carefully. If any one of us writes here 1,000, and then if you do 1.08, keep watching. Sometimes what happens, a different presentation can cause the problem within the student, which it should not be, but it happens. Keep watching this, please, what I'm doing. Power 3, power 4. Let us just use the calculator. Then I'll just show you I'm going to show you something, a different presentation to deal with the same thing. First year is no issue at all. I'm getting 7,500. Why I did not take the inflation in the first year? Because examiner has given us a first year price. First year price means inflation of the first year is already included. Now let's calculate the sales for the second year. 20 multiplied by 1,000 multiplied by 1.08. I'm getting 21,600. Now 50 multiplied by 1,000 into 1.08, then power is going to be 2. Students, I'm getting 58,320. 60 multiplied by 1,000 multiply by 1.08, power is going to be 3. Student, I want you to calculate the values also. I'm getting 75,582. The last one is 95 into 1000. 1.08, power is 4. Let me recheck. 95 into 1000 into 1.08, power is 4. Students, I'm getting 1,29,246. Let's recheck so that we should not be making any arithmetic errors. Okay. Okay. Now, student, listen. These are the sales, okay? Or if instead of this presentation, if someone calculates the sale like this, actually sometimes what happens, students, they go for a rote learning, which is not good at all. You should know, you should try to learn the procedure, how to incorporate the inflation. Units 7.5, 20, 50, 60, 95. Now kindly keep watching. Selling price per unit is 1000, okay? Inflation comes from the second year. What I'm doing, kindly keep watching. 1000 multiplied by 1.08, I'll get the value of the second year. 1000 into 1.08, I'm getting 1080. Now, student, this 1080 is the selling price for the second year. Now, if you multiply this 1080 with 1.08, you will get the selling price for third year. Student, selling price for third year is 1166.4. Now, if you multiply this 1166.4 with 1.08, you will get the selling price for the next year. I'm getting 1259.712. If you multiply this with 1.08, you will get the price for the next year, 1360. Now, I did not show any powers here, a little different presentation. Okay. Now, just keep watching. Logically, here we'll have 7,500. Now, look at this. 20 multiplied by 1080, I am getting 21,600. Now, 50 multiplied by 1166.4. Students, I am getting 58,320. 60 multiplied by 1259.712. I'm getting 75,582. 95 multiplied by 1360. I'm getting 1,29,200. Here, just because of a little bit rounding off, we are getting a different value because I did not take further values. Like if you take that 1259.712 multiplied by 1.08. So after that, we have got 0.48896 also. If I take that also, 95 into 1360.48896, you will get more or less exactly, you will be getting the same result. Sometime even a small rounding off, student, they get confused. Look at this, student. Two different presentations, but the result are same. Sometimes what happens, students, they just go for the rote learning, which is not good at all. Try to understand. If you see the power 2 is here, logically that power 2 is already built in into this value. So I hope, Ruth, now it should be clear to you. One time I have taken the power, second time I have not taken the power, but we're getting the same result. Is that clear now? Kindly reply in the chat box. It is. Thank you very much. So student, I have a request. Do not get confused from different presentations. Try to learn the mechanism. Rather than learning this, okay, here will the power will come and sir has taken the power. Why teacher has not taken the power here? So try to understand logically the impact of power is already built into the selling price. So students, that is all about our first live revision class for the session September 26. Thank you very much that you people have taken out time for today's class to attend this. And please, every Sunday we'll be having a class, and obviously from the second class onwards, duration of the class will increase. Day will remain the same, only one day, once in a week, but duration will increase. And after one more class, we will be solving then in each class, inshallah, we are going to solve a one proper recent past paper questions. And student, let me tell you, we are conducting live revision classes in each and every ACCA paper. In each and every ACCA paper, we are conducting live revision classes. So thank you very, very much. And do give the feedback in your relevant WhatsApp groups about today's class. Thank you.